Welcome to GRE. I'm your host, Keith Weinhold. We're talking about the mortgage loan landscape in this era. Is title insurance a ripoff today? Is it worth it for you to pay discount points at the closing table to get a lower interest rate? Learn about how a cash-out refinance is your ability to borrow tax-free, much like a billionaire does, and what are the dramatic changes that the current administration could take to alter the mortgage environment for years, all today on Get Rich Education.
Since 2014, the powerful Get Rich Education podcast has created more passive income for people than nearly any other show in the world. This show teaches you how to earn strong returns from passive real estate investing in the best markets without losing your time being a flipper or landlord. Show host Keith Weinhold writes for both Forbes and Rich Dad Advisors and delivers a new show every week. Since 2014, there's been millions of listener downloads in 188 world nations. He has A-list show guests include top-selling personal finance author Robert Kiyosaki. Get Rich Education can be heard on every podcast platform, plus it has its own dedicated Apple and Android listener phone apps. Build wealth on the go with the Get Rich Education podcast. Sign up now for the Get Rich Education podcast or visit GetRichEducation.com.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE. From Liverpool, England to Livermore, California, and across 188 nations worldwide, I'm Keith Weinhold, and you are listening to Get Rich Education, the voice of real estate since 2014. It's been estimated that there are about 800 billionaires in the USA, and hey, you might be one of them, but there's a pretty good chance that you aren't. Well, when it comes to lending and mortgages, you can actually take a page out of a billionaire's playbook and do something very much like what they do whenever you perform a cash-out refinance. If you've got dead equity in a property and you can borrow against your own home to a greater extent than you can against your rental properties even, either one of those is a tax-free event. You've now got tax-free cash, and you can use that money on anything from investing it in the stock market to using your proceeds for a down payment on more real estate or buying a boat or going to Disneyland. And you didn't have to relinquish your asset at all. You continue to hold on to the asset. Now, the mechanics are somewhat different, sure, but when you do a cash-out refinance like this, it's a bit like billionaires borrowing against their stock. Instead, you're borrowing against the value of your real estate. In fact, listen into this short clip. It's Trevor Noah talking about how billionaires do exactly this. And you'll notice that the crowd laughs because it actually sounds funny that you can really do this.
The shares that they hold in a company because it is an unrealized gain, right? So they go like, yeah, you're worth 300 billion, but we can't tax you on those stocks because you haven't sold the shares, so you don't have the money. And I understand the argument. They go like, no, you don't have it. It's just what it's worth because it will also crash, and then you have nothing, so we can't tax you on it. Then I'm like, okay, I understand that. Then Elon Musk offers to buy Twitter, all right? He offers to buy it, and then he says in his offer, he goes, I'm putting up my Tesla stock as collateral. Then I'm like, so you do have it? Then he's like, no, I don't have it. I'm just going to say as collateral. So then they accept the offer. He now buys Twitter. Now that they've accepted his offer, he now goes to private equity and banks and other rich people and whatever. He goes like, can you guys borrow me the money to buy Twitter? And then he's like, I want to buy Twitter because I don't want to sell any of my Tesla shares. So I want to use your money to buy Twitter. And then it's like, but then they're like, what are we loaning it against? And he's like, well, my Tesla shares. Then I'm going like, wait. So you can buy a thing based on what you have. Yes. But when we want to tax you, you can say, I don't have it. Do you hear what I'm saying here?
Yeah, you can borrow against your real estate if you have substantial equity in it. We'll talk about just how much. Now, billionaires borrow against their stock holdings using financial products like portfolio lines of credit or securities-based loans. These are the names for how they do it, essentially taking out loans and using their stock as collateral, and this allows them to access cash without selling their assets and without incurring capital gains taxes, much like you can. So you can say that you don't want to sell your property, and you don't have to go through some capital raising round either, like a billionaire might have to when they're borrowing against their stock. You can just have a more standard mortgage application for your cash out refinance. And you don't even have to have a huge portfolio. I mean, even if you just own one 500K property with 50% equity in it, you can do this. So it's available to most any credit-worthy person, again, tax-free. But of course, this doesn't mean that you always should take this windfall, because it often creates a higher monthly payment. You've got to be the one that makes that decision in controlling your cash flows. That is key. I'll talk about that some more with today's terrific guest. Also, the Trump administration's desire to privatize Fannie Mae and Freddie Mac. We're going to talk about that and what that would do to the mortgage landscape. I am in the USA today. Next week, I'll be bringing you the show from London, England for the first time. The following week from Edinburgh, Scotland. Yes, the mobile GRE studio will be in effect. I typically set it up myself, and I usually don't need the help of the hotel staff for an appropriate sound studio either. And then shortly after that, I will be in Anchorage, Alaska, where I'm competing in these fantastic mountain running races. And then by next month, that's where I hope to meet up with you in person for 9 days of learning and fun, as I'll be in Miami as part of the faculty for the terrific Real Estate Guys Investor Summit at Sea, where we're all going to disembark from Miami and go to St. Thomas, St. Martin, and the Bahamas. And then after that great event, it is a long flight from Miami back to Anchorage again. And that's got to be one of the longer domestic flights, not just in the nation, but in the world, Miami to Anchorage. And then shortly after that, I will be in the Great Northeast early this summer, New York and Pennsylvania, including for my high school reunion. So I'll really be putting the miles on these next couple months. One interesting thing that I've noticed for next week's show, where I'll be joining you from London, is how much I'm paying per night at both my hotel in England and then later my hotel in Scotland. That's obviously a short-term real estate transaction. These are some of the more expensive places in the world, really. So next week and then the week after, I just think you'll find it interesting. I'll tell you how much I'm spending per night in both London and then Edinburgh. And they're both prime locations where the hotels are, the center of London and then right on Edinburgh's Royal Mile. That is in future weeks. As for today, let's talk about the mortgage landscape with this week's familiar and terrific guest. I'd like to welcome in one of the more recurrent guests in our history, so she needs little introduction. She's the longtime president of the mortgage company that's created more financial freedom for real estate investors than any lender in the nation because they specialize in income property loans. It's where I get my own loans for my own rental properties, Ridge Lending Group. Hey, welcome back to GRE, Caeli Ridge.
Thank you, Keith. You know I love being here with you and your listeners. I appreciate you having me.
You've helped us for so long. For example, who can forget way back in episode 56? Yeah, that's a deep scroll back when Caeli broke down each line of a good faith estimate for us. That's basically a closing statement sheet. She told us exactly what we pay for at the closing table line by line, like origination fee, recording costs, and title insurance. So helpful. It's just the sort of transparency that you get over there. Buyers pay for title insurance at the closing table. Is title insurance a ripoff? A few years ago, a lot of people speculated that title insurance would fade away because the property's ownership could be transparent and accessible to everybody on the blockchain. But we don't really see that happening. So tell us about title insurance, and really, are we getting value in what we pay for there at the closing table?
Well, I think the first thing I would say is that it really isn't going to be an option. As far as I know, as long as the individual is going to source institutional funding, leverage, use of other people's money, they're going to require the lender, aka Ridge Lending or whoever you're working with, they're going to require that title insurance that insures their first lien position. Doing that title search, first and foremost, is going to make it clear that there isn't some cloud on title, that there isn't some mechanic lien that had been sitting out there for however many years it may have just been around. And those types of things never go away. So, for a lending perspective, it's going to be real important that that title insurance is paid for and in place to protect their interests. Things like judgments, tax liens, like I said, a mechanic's lien, those will automatically take a first lien position in front of a mortgage. So obviously, we're not going to risk that and find ourselves in second lien position in the event of default and somebody else is getting paid before we are. So not really an option. Is it a ripoff? I don't know enough about how often it's paid out and not to speak to that, but I will tell you that it isn't a choice.
Title insurance, like Caeli was talking about, it protects against fraud related to the property's ownership, someone else claiming rights to the property, and this title search that an insurer does, it also, looks for those liens and encumbrances, including unpaid taxes, maybe unpaid HOA dues. But mortgage lenders typically require title insurance, and if you, the borrower, you might think that's annoying. Well, it does make sense because the bank needs to protect their collateral. If a bank ever has to foreclose, they need to have access to you, the borrower, to be able to do that without any liens or ownership claims from somebody else. Caeli, how often do title insurance companies mess up or have to pay out a claim? Does that ever happen?
I mean, if I have been involved in circumstances where that was the case, it's been so many years ago, they're pretty fastidious. I don't know that I could recall a circumstance
Right.
where something had happened and the title insurance was liable. They go through the paces, man. They've got to make sure that, and they're doing deep dives and searches across nationwide to make sure that there isn't any unnecessary issue that's been placed on title. Not that I'm aware of, no.
Are there any of those other items that we tend to see on a good faith estimate that have had any interesting trends or changes to them in the past few years?
Yeah, I've got a good one, and this is actually timely. Credit reports. So, over the last couple of years, something has been happening with credit reports where, maybe 3, 4 years ago, a credit report, let's say a joint credit report, a husband and wife went and applied, that credit report might cost $25. Well, now it's in excess of 100 plus. Some of what we're going to be talking about today, it kind of gets into the wish list of Jim Neighbors, who is the president of the Mortgage Brokers Association. He's been talking to the administration about some of his wishes, and credit report fees is actually one of the things that they're wanting to attack and bringing those costs down for the consumer. So when we look at a standard closing disclosure today, credit report costs have increased significantly. I don't have the percentages, but by a large margin over the last couple of years.
Typically not one of your bigger costs, but a little noteworthy there. One thing that people might opt and choose to have on their good faith estimate, so that borrower therefore would actually pay more out of pocket with today's higher mortgage rates, and I'm sure not to say high because historically they are not high. Do we see more people opting to pay discount points at the closing table to get a lower rate? And talk to us about the trade-offs there.
Right now, first and foremost, that there isn't a lot of option for investment property transactions, whether it be a purchase or a refinance. There's not going to be that option where the consumer gets to choose to say, okay, I want to pay points for a lower rate or not pay points for a higher rate. The not paying points is the key here. There isn't going to be a 0 point option for investment property transactions. And this gets a little bit convoluted. And then I'll circle back and answer the question of when does it make sense to pay the points, more points versus less points. We have been in a higher rate environment than I think a lot of people have become accustomed to. As a result, secondary markets where mortgage-backed securities are bought and sold, they keep very close tabs on the trends and where they think things are headed. Well, something called YSP, that stands for yield spread premium, under normal market circumstances, a consumer can say, okay, Caeli, I don't want to pay any points. Okay, I'll take this higher interest rate and I don't want to pay any points because that higher interest rate is going to have YSP, yield spread premium, to pay compensation to a lender and the other third parties that may be involved in that mortgage-backed security bought and sold and traded, etc. Okay, they have that choice under normal market circumstances. Not the case right now, because when this loan sells, the servicing rights, whoever's going to pick up the servicing rights. So when Mr. Jones goes to make his mortgage payment, he's going to cut a check to Mr. Cooper. That's a big one, right? Or Rocket Mortgage or Wells Fargo, whoever the servicer is. The servicing rights are purchased at a cost. They have to pay for the servicing rights. And let's say that's 1% of this bundle of mortgage-backed securities that they're purchasing. Well, they know the math is that servicer is going to take about 36 months before that upfront cost is now in the black or profitable. This all will lace together, everybody. I promise you, stick with me. So knowing that we've got about a 36-month window before a servicer that picked up the rights to service this mortgage is going to be profitable in a higher rate environment, as interest rates start coming down, what happens to the mortgage that they paid for the rights to service 12 months ago, 18 months ago? That thing is probably going to refinance, right? Prior to the 36-month anniversary of profitability. So that YSP seesaw there is not going to be available for especially a non-owner occupied transaction. So said another way, 0-point rates are not going to be valid on a non-owner occupied transaction in a higher rate environment when secondary markets understand that the loans that are secured today will very likely be refinanced prior to profitability on the servicing side of that mortgage-backed security.
That is a risk to the lender.
Yes. So we know that right now you're not going to find a 0-point option. Now, that may be kind of a blanket statement. If you were getting a 30% loan to value, owner-occupied mortgage with 800 credit scores, that's going to be a different animal. And of course, you're going to have the option to not pay points. The risk for that is nothing. Okay. YSP is going to be available for you, the consumer, to be able to choose points at a lower rate, no points, higher rate. When does it make sense to pay additional points, let's say, to reduce an interest rate? The break-even math, and I'm always talking about the math, the break-even math is actually, the formula is very simple. All you need to do is figure out the cost of the points, dollar amount of the points. Let's say it's $1,000. And that's what it's going to cost you to, say, get an eighth or a quarter or whatever the denomination is in the interest rate reduction. But you aren't worried about the interest rate necessarily. You're looking at the monthly payment difference. So if it's going to cost you $1,000 in extra points, but it's only going to save you $30 a month in payment, when you divide those two numbers, what's that going to take you?
33 months.
Well, okay. And does that make sense? Am I going to refinance in 33 months? If the answer is no, then sure, pay the extra $1,000. But that's the math. The cost versus the monthly payment difference, divide that. That gives you the number of months it takes to recapture cost versus cash flow or savings. And then you be the determining factor on when that makes sense.
That's pretty simple math. Of course, you can also factor in some inflation over time. And if you would invest that $1,000 in a different vehicle, what pace would that grow at as well? So we've been talking about the pros and cons of buying down your mortgage rate with discount points. Before we get into the administration changes, Caeli, talk about that math in, is it worth it to refinance or not? It's a difficult decision for some people to refinance today with higher mortgage rates than we had just a few years ago. And at the same time, we've got a lot of dead equity that's locked up.
I would start first by saying, are we looking to harvest equity? Are we pulling cash out, or are we simply doing a rate and term refinance where we're replacing one loan with another loan? If it's for rate and term, if we're simply replacing the loan that we have today with a new loan, that math is going to be pretty simple. Why would you replace 6% interest rate with a 7% interest rate if all other things were equal? You wouldn't, unless there was a balloon feature or maybe an adjustable rate mortgage or something of that nature involved there that you have to make the refinance. So taking that aside, focusing on a cash out refinance and when does it make sense? So there's a little extra layered math here. The cash that you're harvesting, the equity that you're harvesting, first of all, borrowed funds are non-taxable. What are we going to do with that pile of cash? Are we going to redeploy it for investing? More often than not, talking to investors, the answer is yes. What is that return going to look like? So you've got to factor that in as well. And then we'll get to the tax benefit in a moment. But generally speaking, I like to, as long as the cash flow is still there, okay, you've got to have someone else covering that payment. Normally, there's exceptions to every rule. I don't normally advise going negative on a cash out refi. There are exceptions, okay? Please hear me. But otherwise, as long as the existing rents are covering and that thing is still being paid for by somebody else, then what you want to do is look at that monthly payment difference again versus what you're getting out of it. And then you divide those two numbers pretty simply. And it'll take you how long. And then you've got to layer in the cash flow that you're going to get from the new acquisitions. And whether that be real estate or some other type of investment, whatever the return is, you're going to be using that to offset. And then finally, I would say make sure that you're adding in the tax benefit. These are rental properties, guys, right? So closing costs can be deducted. Now, that may end up hurting debt to income ratio down the road. So don't forget, Ridge Lending is going to be looking at your draft tax returns. Very, very important to ensure that we're setting you up for success and optimizing things like debt to income ratio on an annual basis.
Now, some investors or even primary residence owners might look at their first and only mortgage on a property, see that it's 4%, and really not want to touch that. What is the environment and the appetite like today for having a refinance in the form of a second mortgage? That way you can keep your first mortgage in place at, say, 4%, get a second mortgage at 7% or more. How does that look for both owner-occupied and non-owner-occupied properties today?
You're going to be looking at prime plus in many cases. If you don't want to mess with a first lien, a second lien mortgage is typically going to be tied to an index called prime. Those of you that are familiar with this have probably heard of that indice. There's lots of them. The Fed fund rate, by the way, is an index. There's lots of them. The Treasury is also another index. Prime is sitting, I think, at 7.5%. So you're probably going to be looking at rate-wise, depending on occupancy and credit score and all of those LLPAs that we always talk about, loan level price adjustment. It could be prime plus 0. It could be prime plus 4. So interest rates could range between, say, 7.5 on average up to 11, even 12%, depending on those other variables. More often than not, those are going to be interest only. So make sure that you're doing that simple math there. And I would prefer, if I'm giving advice, the second liens, the HE loan, which is closed-ended, very much like your first mortgage. It's just in second lien position. It's amortized over a certain period of time, closed-ended. Not as big a fan of that. If you can find the second liens, especially for non-owner occupied, I would encourage it to be that open-ended HELOC type.
What are we looking at for combined loan-to-value ratios with second mortgages?
On an owner-occupied, I think you'd be happy to get 90. I think I've heard that in some cases they can go up to 95%. In my opinion, I would go as high as they'll let you go, right? On a non-owner occupied, I think you'd be real lucky to find 80 and probably closer to 70.
That really helps a lot with our planning. Well, the administration that came in this year has made some changes that can create some upheaval, some things to pay attention to in the mortgage market. We're going to talk about that when we come back. You're listening to Get Rich Education. Our guest is Ridge Lending Group President Caeli Ridge. I'm your host, Keith Weinhold. The same place where I get my own mortgage loans is where you can get yours, Ridge Lending Group, NMLS 42056. They provided our listeners with more loans than anyone because they specialize in income properties. They help you build a long-term plan for growing your real estate empire with leverage. Start your pre-qual and even chat with President Caeli Ridge personally. While it's on your mind, start at ridgelendinggroup.com. That's ridgelendinggroup.com. You know what's crazy? Your bank is getting rich off of you. The average savings account pays less than 1%. It's like laughable. Meanwhile, if your money isn't making at least 4%, you're losing to inflation. That's why I started putting my own money into the FFI Liquidity Fund. It's super simple. Your cash can pull in up to 8% returns and it compounds. It's not some high-risk gamble like digital or AI stock trading. It's pretty low risk because they've got a 10-plus year track record of paying investors on time, in full, every time. I mean, I wouldn't be talking about it if I wasn't invested myself. You can invest as little as $25K, and you keep earning until you decide you want your money back. No weird lockups or anything like that. So if you're like me and tired of your liquid funds just sitting there doing nothing, check it out. Text FAMILY to 66866 to learn about Freedom Family Investments Liquidity Fund. Again, text FAMILY to 66866.
This is Hal Elrod, author of The Miracle Morning, and listen to Get Rich Education with Keith Weinhold, and don't quit your daydream.
Welcome back to Get Rich Education. We're talking about mortgages again because this is where leverage comes from. I'm your host, Keith Weinhold. We're sitting down with the president of Ridge Lending Group, Caeli Ridge, and I know that she has some knowledge and some updates on new administration leadership and some potential changes for the market there. What can you tell us, Caeli?
I'm pretty excited about this one, and I'm watching very diligently to see how it unfolds. So the new director of the FHFA, Federal Housing Finance Agency, y'all, is Bill Pulte. This is the grandson of Pulte Homes.
Right.
Okay. Smart guy. I'm excited to see what he's going to come in and do. Well, he had recently, I think in the last couple of weeks, he put out in the news wires asking for feedback from the powers that be related to Fannie and Freddie, what improvements they would like to see. So first up was Jim Neighbors. He is the president of the Mortgage Brokers Association. He had a few very specific wish list items, if you will. And the first one on his list was the elimination of LLPAs for non-owner occupied and second homes. So let me just kind of paint a picture here because there's some backstory I think is important. So an LLPA, for those of you that have never heard that term before, stands for a loan level price adjustment. And a loan level price adjustment is a positive number or a negative number that associates with the individual loan characteristics. So things like loan to value or loan size. Occupancy is a big LLPA, the difference between an owner occupied where you live and one that you're going to use as a rental property. That's a big one. Credit score, property type. Is it a single family? Is it a 2 to 4? Is this a purchase? Is it a refi? Anyway, all of those different characteristics are LLPAs. Well, if we take a step back in time, about 3 years ago now, Mark Calabria at the time was the director of the FHFA, and he had imposed increases, specific increases. This was middle of 22, I want to say, specific increases to the LLPAs for non-owner occupied property. So if anybody kind of remembers that time, we started to really see points and interest rates take that jump sometime in 2022, more than just the traditional interest rate market and the fluctuations. This was very material to investment property and second home, but we'll focus on the investment property. So Mr. Jim Neighbors came in and said, first and foremost, I'd like to see those removed. And I want to read something to the listeners here because I thought it was very interesting. This is something I've been kind of preaching from the rooftops, if you will, for many, many years.
Yeah, we've got Neighbors sticking up for investors here.
He really is. And yes, he is. And more often than not, they're focused on the owner occupied. So I'm just going to kind of read. I've got my cheat sheet here. I want to make sure I get it all right for everybody. So removal of the loan level price adjustments on investment properties and second homes. He noted that these risk-based fees charged by Fannie and Freddie discourage responsible buyers from purchasing second homes and investment properties with that significant increase to cost. And here's the important part. Originally introduced to account for additional credit risk, many of the pandemic-era LLPA increases were not based on updated risk metric. In fact, data has shown that loans secured by investment properties often have strong credit profiles and lower than expected default rates. I mean, anybody that has been around long enough to see what we've come from like 08, 09, and when we had the calamity of, right? The barrier for entry for us to get any conventional financing as investors has been harsh. I mean, I make that stupid joke of vials of blood and DNA samples, but aside from it being an icebreaker, it kind of feels true. We really get the short end of the stick. And I feel like as investors, especially post 08, 09, our credit profiles, our qualifications, the bar is so high for us. The default risk there has largely been removed. We've got so much skin in the game with 20, 25% down, credit scores much higher, debt to income ratios more scrutinized, et cetera, et cetera. So I think that this is, if it passes muster, I think this is going to be a real big win for the non-owner occupied side of agency, Fannie Mae, Freddie Mac lending.
The conventional wisdom is that if you, the borrower, get into financial trouble, you're more likely to walk away from your rental properties than you are your own home. And Neighbors, sort of like a good neighbor here, sticking up for us and stating that, hey, us, the investors, we're actually highly creditworthy people.
Yeah, absolutely. So fingers crossed, everybody. Say your prayers to the LLPA and mortgage investor rates gods.
We'll be attentive to that. What other sorts of changes do we have with the administration? For example, I know that Trump and some others in the administration have talked about privatizing the GSEs, those government-sponsored enterprises, Fannie Mae, Freddie Mac, and what kind of disruption that would create for the industry. Is there really any credence to that?
They've been talking about it for quite a while. I mean, as long as Trump has been kind of on the scene, that's been maybe a wish list for him. I don't see that happening over the next years. That is an absolute behemoth to unpack and make a reality. Speaking of Mark Calabria, he was really hot and heavy on the trails of doing that. So what this is, you guys, so Fannie and Freddie are in conservatorship. That happened back post 0809, and privatizing them and making them where it is not funded or conservatorship within the United States government. Now, it still has those guarantees against default. It's a very complicated, complex, nuanced dynamic of mortgage-backed securities. But if we were to privatize them at some point, now, am I saying that that's a bad thing? No, not necessarily. But I think it has to be very carefully executed. And because there are so many moving parts, I do not think that just one term of presidency is going to make that happen. If we do it, it's going to be years down the road from now, is my crystal ball. I don't think we're going to see that anytime soon.
That's interesting to know. Are there any other industry changes that are important, especially for investors, whether that has to do with the change in administration or anything else?
Well, specific to that wish list from Mr. Neighbors, one of the other things that he had asked, and there were quite a few for owner-occupied changes as well, he wants to reduce the seasoning for cash out refinances of investment properties, which would be huge.
Good.
Yeah. Right now, it's 12 months on a cash out refinance, given very specific acquisition details. Okay. I won't go down that rabbit hole. But currently, if you haven't met exactly these certain benchmarks, you may have to wait 12 months to pull cash out of a property from the day that you acquire it. He's asking that that be pulled back to about 6 months, which would be nice.
Reducing the seasoning period from 12 months to 6 months, meaning that an investor, a borrower, would only need to own that property for that shorter duration of time prior to performing a refinance.
Cash out refinance. No seasoning required on a rate and term. This is specific for cash out, but exactly right.
Now, one trend that I think about sometimes, especially when I think back to 2008, 2009 days, since I was an investor through that time, is are there any signs in the reduction of the appetite or the propensity to lend, to make loans? So how freely is credit flowing?
I think pretty freely. I'm not seeing that they're tightening the purse strings. That's not the lens that I'm looking at it from. And I try to keep that brushstroke broad. There have been, I think that on the post-close side, there's been a little extra from Fannie Freddie, and I think that has to do with profitability markers. But overall, I'm not seeing that products are disappearing necessarily or that guidelines are really becoming even more cumbersome. If anything, I would say it's maybe the reverse of that. And I do believe that probably is part and parcel to this administration and the real estate background that comes with it.
One other thing I pay attention to, but it just really hasn't been much of a story lately, are delinquencies in foreclosures. It seems like they've ticked up a little bit, but they're still both really historically low. And basically, a delinquency being defined as when a borrower makes one late payment, and foreclosures being the more severe thing, typically a 120 days late or more. Any trends there?
I'm not seeing any, no. And in fact, I would tell you that because we focus so much on investor needs, first payment default is, I can count on less than one hand if I had to, how many times I've seen that happen with our clients over their 25 years. So nothing noteworthy there for me.
Yes, I mean, today's borrowers are just flush with equity. Nationally, there's a loan to value ratio of 47%, which is healthy in a sense. On average, borrowers have a 53% equity position. Of course, the next thing I think is like, I don't really know if that's a smart strategy. They're not really getting that much leverage out there, but I think a lot of people just have the old mentality of get it paid off.
And I think that depending on where you are in your journey, I mean, if you're in phase 3, right, where you're just really looking at these investments, these nest eggs to carry you into your retirement and or for legacy reasons, fine. But otherwise, I may argue the point in that I don't care that you have a 3% interest rate on an investment property or whatever it may be. If it's sitting there idle and as long as it can cash flow, the true chances of those individuals of keeping that mortgage that they got in 2020, 2021, et cetera, at those ridiculously low interest rates and stroking 360 payments later to pay it to zero is a fraction of a percent.
Right.
Now, whether they're on the sidelines for something else, I don't know. But that debt equity, I think, is hurting them more than a 3% interest rate is helping them.
And a lot of times the mindset of someone is if they don't need to build wealth anymore and they're older and they already built wealth, they don't care if their loan to value is down to zero and they have it paid off.
Sure.
Whereas someone that's in the wealth building phase probably wants to get more leverage.
Yeah.
Caeli, at Ridge Lending Group there, you see so many applications come in, and especially since you're an investor-centric lender, I like to ask you what trends you're seeing. What are people buying? What are people doing? Are they refinancing? Are they paying loans off? Are they trying to take out more credit? Are there any overall trends with investors that you see in there?
Right now, I think the all-in-one is a clear winner there. The all-in-one, that first lien HELOC that you and I talked about, we broke my little corner of the internet with that one. That one is a front runner for sure. On the refinance side specifically, we are seeing quite a bit more on the refi side of things. That equity is kind of just sitting there. So even though if the all-in-one isn't a good fit for them, I'm seeing investors that are willing to tap into that equity instead of just sitting around and waiting for them to potentially lose some equity if the housing market does start to take some decline. And then I would say on the purchase transaction side, something that's kind of piqued my interest is the pad split. I'm looking at that more often where, for those that are not familiar, you can probably speak more to this, Keith. They're buying single family resident properties, even 2 to 4 unit properties, and a per bedroom basis, turning those into rental properties. And they're looking to be quite profitable. So I've got my eyes on that too.
Before we ask how we can learn more about you and what you do in there at Ridge, Caeli, is there any last thing that you'd like to share? Maybe a question I did not think about asking you, but should have?
I would like to share with your listeners that if they are not working with a lender that focuses on their education and has that diversity of loan product that we have, that they're probably in the wrong support group. You need to be working with a lender that has a nationwide footprint and that has diversity of loan product to cover whatever methodology of real estate investing that you're looking for, and really puts a fine touch on the education of your qualifications and your goals as they relate to underwriters' guidelines.
What we're talking about, and I know this through my own experience in dealing with Ridge, since I use them for my own loans myself, is sometimes Ridge might inform you that, hey, you can go and do this and make this deal now, but that's going to mess up this bigger thing 12 months down the road. Whereas if you talk with an everyday sort of owner-occupant mortgage company, oh, they're just not going to talk like that because owner-occupants, they might only buy every 7 years or something like that. And investors are different, and you need to have that foresight and look ahead. Caeli, this has been great, a really informative conversation about the pulse of the market. Tell us what products that you offer in there.
Our menu is very, very diverse. I would say it's probably easier to describe what we don't offer. We do not have bare lot loans or land loans. We're not offering those right now. We do not have second lien HELOCs currently. We suspended that 2 years ago. But otherwise, guys, we're going to have everything that you're going to need. So just very quickly, I'll rattle off Fannie, Freddie. Okay, those golden tickets that we talk about. We've got DSCR loans, bank statement loans, asset depletion loans, ground up construction, short-term bridge loans for fix and flip or fix and hold. We have our all-in-one, that's my favorite, first lien HELOC. We have commercial loan products for commercial property and residential on a cross-collateralization basis. So very, very robust in the loan product space.
Caeli Ridge, it's been valuable as always. And then ridgelendinggroup.com or your phone number?
855-747-4343, 855-74-RIDGE. And then to reach us an email, if that's your better mechanism to contact us, info@ridgelendinggroup.com.
That's been valuable as always. Thanks so much for coming back onto the show.
Appreciate it, Keith.
Yeah, terrific information from Caeli as always. If you're enamored of borrowing tax-free like a billionaire against your real estate, they sure can help you out with that and determine whether that's right. It doesn't mean that you always should, but if you have investment ideas for debt equity and you're attentive to cash flows, run the numbers with them and see if it's worthwhile. As far as new purchases, We all know that soured affordability has made it especially tough for first-time home buyers, and there's more data out there that shows that tenant durations are historically long, longer than they usually are. Tenants are staying in places longer because they have to. Investor purchases have stayed strong, though. Investors have been buying about the same proportion of single-family homes and making them rentals that they have historically. And Redfin tells us that the value of properties that investors have purchased is up more than 6% year over year. So investors are still buying, and that makes sense. We're in this era where there's more uncertainty than usual, there's higher stock volatility than usual, and more people are sort of asking themselves, where would I get a better return than on income property? And where would my return be more stable today than in income property as well? If you work with Ridge Lending Group for a time, you're probably going to understand why I personally use them for my own loans. You'll notice that they really understand what investors need. Thanks to Caeli Ridge today, and thank you for being here too. But as always, you weren't here for me, you were here for you. Until next week, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
You know, whenever you want the best written real estate and finance info, oh, geez. Today's Experience limits your free articles access, and it's got paywalls and pop-ups and push notifications and cookies disclaimers. It's not so great. So then it's vital to place nice, clean, free content into your hands that adds no hype value to your life. That's why this is the golden age of quality newsletters, and I write every word of ours myself. It's got a dash of humor, and it's to the point because even the word abbreviation is too long. My letter usually takes less than 3 minutes to read, and when you start the letter, you'll also get my 1-hour fast real estate video course. It's all completely free. It's called the Don't Quit Your Daydream letter. It wires your mind for wealth, and it couldn't be easier for you to get it right now. Just text GRE to 66866. While it's on your mind, take a moment to do it right now. Text GRE to 66866. The preceding program was brought to you by your home for wealth building, GetRichEducation.com.